All right, everybody. Stocks by the numbers. Welcome back. Today is Tuesday, and we have some earnings coming out here after the close. Got a little over an hour and a half. Trying to come to you here with my personal earnings predictions today, just a little bit earlier than usual. First company on the list, CrowdStrike Holdings, ticker symbol CRWD, listed here on the NASDAQ. This stock has been on an absolute tear. If we go back here, looking at the one-year chart, we can see roughly 12 months ago, we are up, what is that? Almost 150% about, we'll call it. Over the last 5 years, it's been growing nicely, but in my opinion, this stock just could have gone too high too quick, and it's a rough situation because technically in the numbers, in my opinion, everything looks pretty good actually. We have a market cap up here at 70 billion, right? The company slightly negative here on the EPS side. The last several quarters has been coming in above analyst expectations on the profitability side, beating 4 straight quarters in a row on the EPS. And look at the revenue here, consistently climbing up. 580 million, 637, almost 700, 731, 786. These earnings coming in, revenue jumping up to 839 million. Now look, if the company hits that number or surpasses it, which it showed has a pretty good track record of them coming in above these expectations, right? So if they beat this number, I can appreciate the fact if we may see even like a 2-3% pop here after hours. And again, the company, who knows, could announce, a share buyback or something like that. But overall, in my opinion, I have to say personally, I think it's actually a little too high. And I'm not bashing the company. Again, the last couple of quarters, you can see net margin goes positive. We switch over here annually. Look at this growth here from a couple of 100 million, sub $1 billion in 2020, up to almost 1.5, up to almost 2.25. And now for 23, Q4 coming in today after the close, they're looking to close out 2023 with 3.05 billion for the year. Market cap 70 billion. So that's why I think the stock is taking a hit today here is 7%, because even if we look at the news, you can see CrowdStrike recently maintained outperformed by Wedbush, actually got a price target increase here to 350 from 278, calling for just the increase in their subscriber growth and their account numbers, which of course have been very impressive. I cannot lie. And you can see price target here 350, Needham from 3.25 up to 350, maintains buy rating. Wells Fargo up to 380 from 315, maintains overweight rating. Now granted, in my opinion, I'm not necessarily disagreeing with this longer term outlook, but like I always say, when these stocks rage, what goes up must come down. And this is why I'm saying again, I understand the market's taking a hit, and you would think that a company performing with this type of stable earnings reports would not take a hit today. But this is what I always say, right? I say that you should look for cheaper, fair valued, or potentially discounted shares from where we think personally the quote unquote fair value would be for the stock. And this is exactly what I'm saying, right? So let's say 3 billion for the year, again 70 billion. So what's that? Over 23 times this year's revenue, right? That is a pretty high multiple. And I understand it's in a tech space, it's growing consistently, they're consistently coming out above estimates. I understand that. But when we take a stock to such heights, this is literally what I've been saying. When the markets have a big sell-off or a correction, you have to take the stock down because you took it up so much. You understand? So even if the company is going to come out and post 850 million and beat those estimates, in my opinion, it is justified that it's down roughly 7.33%, even though I'm sure people are upset. And unfortunately, moving forward, I actually think that regardless of if they beat earnings or not, the stock really should take a hit. Personally, I'm looking for like a 10-15% pull-off here, pullback. If we switch over here to stock charts, we can see, look at the RSI was well above 70 this whole time, and the stock just continued to climb. Had that flash crash and closed, looks like right at the 50-day moving average. Bounced up, stayed above the mid-Bollinger Band for a little while, and then rejected, and today chunked down. Now currently below the 50-day moving average here on the daily of 293.62. Stock currently sub 291 now. So this pullback here to this 200-day 203, that might be a little excessive in my opinion. Obviously, the MACD has been dropping down, but it was raging for months and months, right? With the RSI out of control above our benchmark of 70. So all of this is justified, in my opinion. RSI on the daily Still sitting a touch below 41. Even here on the weekly, though, look at the RSI up here. I mean, this thing was above 70 going back to the beginning of November when markets began to rebound and go into that random rally, hitting these new highs, right? So that whole time, the stock was raging, worth more than it should have been, in my opinion, continued to climb up, hit new highs, get above 300, everyone's happy. Now it seems like it's slowly coming back down to earth. Again, RSI on the weekly sitting at about 64 to third. The stock chunking down here. I think it makes new lower lows here from that point. That's why I'm saying 10 to 15%. I think the pullback right there to the weekly mid-Bollinger Band 260.72, in my opinion, would be justified even if the company beats. That may potentially cross the MACD. That may potentially cause, the MACD to cross to the downside, which may accelerate the sell-off even more, bringing us down potentially even into the 250s. But overall, again, we just looked at the numbers. We look at how the company's growing. Their subscriptions are consistently climbing. So obviously, it's a brand name in the space. And again, I'm not bashing the company. All I'm saying is I would like it personally at a little bit more of an attractive price. If you are involved with CrowdStrike, please do not come after me because you are up significantly. So even if you have a pullback, honestly, you really shouldn't be too upset. Next stock on the list is ROST Stores, ticker symbol ROST, listed here on the NASDAQ. There's an apparel company sitting here at $149 a share, down about a point, about 0.6%. We can see the stock was close to 52-week highs today. We're in like this little downward consolidated little channel here. We have a $50 billion market cap. We're paying out a dividend yielding less than 1%. We have a PE of sub 30. Company's earning $5 a share, not too bad. The last 4 quarters beating on the EPS side, very nice. Switching over here quarterly, you can see we're kind of bouncing around, but it looks like the company's maintaining that $4.5 billion level and then bouncing back close to 5 here in the last couple of quarters. Net margin has been, for the most part, steadily stepping up over the last 4 or 5 quarters. Switching over here annually, we can see we grew from about 15 to 16 billion. Then we got locked down. We came out almost 19 billion and then 18.7 with the net margin taking about a 1% hit, right? So 18.7, and we have 5, we'll call it 10. It's about 14.5. So we're looking for 19. We're looking for almost 20 billion here to close out the year. And we have a market cap of only 50 billion, right? So the PE could be viewed as a little high. Revenue to market cap comparison, only about 2.5 times. So pulling back here, the stock obviously has been on an absolute freaking rage here. You can see the big sell-off was in the 120s, drops all the way down to sub 60, immediately climbs back up to 130s and makes those new highs, but consistently makes higher lows, and for the most part seems to be making higher highs. So in my opinion, at first glance, I would probably say that this stock is undervalued potentially in the numbers, and we could see some growth. Let's just check the history. Let's check the debt. So the first half of 22, we had a couple of misses. Before and after that, looks like we have a lot of beats here. So we have 6 of 8 beats in the last 8 quarters. And even going back all the way to 2015, the company has just missed once. And of course, the whole country had to be locked down for them to slightly miss those estimates. And then they come back like a powerhouse, beat by about 1/3% on the annual revenue numbers for 21 and 22. And you can see for 23 now, fiscal year north of 20 billion. And moving forward, we're expecting continued growth. North of 21 billion, north of 22.25 billion, north of 24.25 billion. So if you're telling me you're bullish on this stock and you're holding for the longer term, I can probably see what you're talking about. Even the EPS we can see for 23, now jumping above $5 a share, and then moving forward almost 6, over 6.5, over 770 a share by 2026. So in my opinion, this company is showing some good growth and is showing some strong numbers here. The debt obviously has gotten out of control. The dividend had to pull back 90, 102, 114, 124. Okay, so they got back to the dividend heights they were with an increase in 21 and then increased again in 22. In my opinion, that is a green flag, not a red flag. We have assets outweighing liabilities. Looking at the debt, 571, 573, 578, 578. Cash flow bouncing around, not really where it's been. Cash kind of maintaining that 4.5 billion mark. Yep, assets outweighing liabilities, book value consistently climbing. We are trading like 12 times book value or something like that. Okay, a lot of these numbers seem pretty in line. Operating expenses have been climbing up a little bit, but again, revenue kind of maintaining, slowly climbing back to 5 billion. Gross profit seems to be slowly inching higher. Operating income back above that 500 million mark. Overall, in my opinion, a lot of these numbers do look good, but again, looking historically, you can see the stock, for the most part, was trading at like the low 20s PE. Now we're at almost 30, and again, the stock's been on a tear. So with that debt as well, again, what, 4.5, 5 billion in debt or whatever it was, that is a big chunk of the company. So I don't know, this one might be hard to call. Trading 11 times book, that's the highest it's been going back the last 7 or 8 quarters. Price to cash flow is a little higher, but going back, it was trading at a much, much higher multiple. The return percentages are all up in the last couple of quarters here. Gross margin is maintaining this 27 plus mark. Operating margin as well has been holding 11%. EBITDA was 13.39, hasn't quite gotten back there yet, but dipped down into the 12s, got back above into the 13s. The net margin has been stepping higher. Asset turnover now higher than it was. Inventory turnover does seem to be stepping down. Our debt ratios have been decreasing, though, as the value of our assets and our equity has apparently been consistently increasing. So our debt to blank ratios, as you saw, were slowly decreasing. I mean, you know, you could kind of make, excuse me, you could kind of make the argument for each way, but I mean, it does seem like we have like this big wedge here, kind of for the most part, right? But technically, we're not at the apex. And you can see the apex a couple of weeks out. Yeah, Ross Stores actually, you know, in my opinion, it looks like it has been growing pretty well. So I might have to say, in my opinion, maybe calls on Ross Stores here, ROST. Looking here on the weekly, we can see the RSI is well above our benchmark of 70. Basically been on a tear since November, of course, like so many other things. MACD steadily climbing. Let's switch over to the daily quickly. And we could see RSI just dipped down below that 70 benchmark. MACD potentially about to cross to the downside. Let's see if we have any news here. Gears up for Q4 print. Anything recent? Anything recent? Will strong demand aid Ross Stores? Well, it should, technically, right? And I also saw, I believe it was not Hershey, frickin' Target, I believe, just had a nice pop. Price target increased to 165 from 155, maintains outperform. Yeah, I think they do it. I do think they do it. I know I mentioned the debt, and a couple of the numbers, of course, aren't consistently climbing quarter over quarter, but Ross Stores, I think, in my opinion, if I was to take a position, if I had the capital, I'd probably go with Ross Stores calls. What was the other one? CrowdStrike puts, in my opinion. ROST store calls. Looking here at ChargePoint, yeah, I kind of called out that this stock would continue to struggle and continue to sell off. You can see we dropped down, hit these lows here of $1.56. Everyone was pumped about this stock, and I know was upset when I said that in my opinion it really wasn't looking too good. And then of course we completely fell off a cliff. Now estimates 119.78 million. Losses have widened the last 2 quarters. And again, we kind of just have inconsistent revenue. Last Q4, 152.83 million. Now for Q4, 119.78 million. So even if they do beat, that's roughly a 20% decrease year over year in revenue. And of course, again, you can see the losses widening and the net margin falling off a cliff as of last quarter, minus over 100%. So again, in my opinion, I would wait for the company to prove itself. And again, 100 million in change. I mean, you're talking 400 to 500 million for the year, which is, a little less than 2 times our market cap. But again, the company is inconsistent and had losses widening here as of late. Let's just check the financials quickly. And we can see the debt jumped up for 22. 317 million, 315, 315, 301. So it's actually slowly been going down, the debt, for the last couple of quarters. The cash flow, free cash flow, now sitting back at minus 100 plus million. The cash on hand actually has climbed up. As you see, this blue bar, almost 400 million. We do still have assets outweighing liabilities. And this is the problem. In my opinion, looking at, like the debt going down, the cash going up, the assets outweighing liabilities, trading less than 2 times yearly revenue to market cap, right? A lot of these things that you guys notice that I specifically look for, we could make the argument, oh no, well, based on what you said, those are good things, not bad things, right? But it's and justified. However, again, the reason why I think I got this one correct was just because of the inconsistency of the company itself, missing earnings more times than not, and again, the losses widening for the last couple of quarters. So this company, again, even if they beat or post around this 120 million mark, this time last year they brought in 150 million for this same quarter, this same time last year. So in my opinion, I mean, they need to beat, and they need to beat big. And I think they have to come out and post like 138 million, 142 million. They have to annihilate this number, but also more importantly, they have to be in line or more narrow on the loss side than this right here, also of a loss of 23 cents. Because again, going back last quarter, you could say, oh, they missed by a chunk on the revenue. All right, that's fine, but I understand it's still a newer company, right? They're hit and miss. Okay, fine. But the problem is also here, the estimates of a loss of 31 1/3 cents. The company comes in losing 43 cents a share. So the problem is when you're inconsistently posting your revenue estimates, and they're hit and miss, they're hot and they're not. The problem is, again, because of the inconsistencies, you are now increasing the bleeding if you're not operating at a positive, obviously, as you can see. And now the losses are widening more than expected. And I bet if they brought in the extra 14, 15 million and were in line with what Wall Street was estimating, then they probably would have lost, 32 or 33 cents a share and missed by much less than 37% on the EPS side, right? It would have been more of a narrow loss. But the problem is ChargePoint seems to be struggling, and I'm sure in the technicals we could potentially make the argument of seeing some little value coming in, some little pop that could potentially happen. But in my opinion, I would wait for the company to prove itself. I would still stay away from ChargePoint, and I would probably buy puts on ChargePoint. No, wait. There we go. ChargePoint, we come down here, we can see recent rejection off of the 50-day moving average, MACD relatively flat, RSI sitting at 48.5. The company was sub 30 for quite some time as it was falling off a cliff, and in my opinion, severely overvalued from day one. So the RSI can't really be, in my opinion, one of our leading indicators. on the daily anyway. Even on the weekly too, we can see we were sitting below 30 for quite some time. Now the RSI slowly inching up back to above about 33.5, but for the most part, I mean, we technically don't have these multiple bottoms. However, with the top trend line coming down, I mean, we could potentially drop more towards this bottom Bollinger Band 156. That would kind of form a potential descending wedge along with a double bottom retesting those 52-week lows, and then we could potentially bounce back to about 2.25 back to that mid Bollinger Band. But again, only time will tell. But in my opinion, I just think the losses continue and the inconsistencies in the revenues continue as well, in my opinion. And I think ChargePoint, I would go with calls, or I would just stay away, in my opinion. Nordstrom, now Nordstrom, ticker symbol JWN, listed here on the New York Stock Exchange, retail company, right now trading about $21 a share, up about 40 cents, having a 2% day here, roughly 10% away from the 52-week high. We have a market cap $3.4 billion. We're paying out a dividend yielding about 3.7% with a PE at about 29. Company's earning 73 cents a share, beating on the EPS side 4 quarters in a row. Switching over here on the revenue side, we can see $3.5 billion up to $4 billion, back down to 3.1, 3.7, back down to 3.3. So we have not only revenue bouncing around, but of course our net margin as well. We're swinging positive one quarter, we're dropping negative another quarter. Let's see what these analysts are saying. Wow, everyone has a lower price target on this stock compared to where it's currently trading right now. We have 20 analysts covering the stock, 4 giving it a strong buy, 11 saying to hold, 1 giving it a sell, 4 giving it a strong sell. So in my opinion, just off first glance, they are probably citing, the growth in e-commerce and the fact that Nordstrom may potentially be left by the wayside. And this is why, again, going back here, even 21, you can see $4.5 billion. Well, Q4 actually looks to be their biggest quarter, probably with the holiday shopping. 432, we dropped down, missed by 0.5%. Now we're back up to 438 billion. So, in my opinion, it may be hard for them to get back above that estimate. But looking at the historical performance of the stock, we can see they beat on the revenue side 6 of the last 8 quarters, beating on the EPS side 7 of the last 8 quarters. Switching over here annually, a little bit of a different story, right? On the annual side here, on the profitability side, we're looking at 50-50 results. And on the revenue side here annually, we have 5 beats and 3 misses. However, 4 beats in a row here. But now you can see for 23, revenue estimated to pull back down now, sub 15 billion, which again, they were doing back here in 2017, 2018, 2019. Now we're back to sub 15 billion and apparently staying there, not potentially getting back to that level until 2026. And remember, in my eyes, the dollar is getting weaker and weaker, which means in 23 here, 14.61 billion, right? And then 24, 14.63 billion, but the dollar's getting weaker, which means they're going to be, charging more dollars per item to less frequent customers, right? Less traffic, if that makes sense. Then in 25, you can see basically the same thing. They're just looking to maintain the revenue with a slight bump here. So again, I feel like the traffic is moving away from Nordstrom, and even by potentially pumping up some of their prices to maintain these revenue levels, as you can see, we're essentially stagnating for about the next 2 to 3 years. So in my opinion, I can appreciate the fact as to why a lot of these analysts are just kind of throwing out the sell. Okay, stop paying the dividend, reinstated in 22. Revenue jumped up to 5 billion, 4.7, 4.5, sub 4.5, back up to 4.5. The cash was up to 700 million, 580, 885, down to 375, with the free cash flow going negative last quarter. Q4 does seem to be a good quarter, it looks like, for Nordstrom. Again, holiday season, so I would assume that's where, the most of the bulk of their traffic and sales come from for the year. We can see assets, we're climbing back up above 9 billion. Liabilities have stepped down. Equity now back above 700 million mark. Book value per share, not the highest it's been, but has been steadily climbing the last couple of quarters, back up to about 450. So we're trading, a little less than 5 times book value. Let's see if we have any recent news coming out. So he concludes to Nordstrom, maintains dividend. Yeah, see, and you keep seeing headlines like this in the space. TJ Maxx parent logs strong quarter on robust holiday traffic. But the problem is, the question is, excuse me, not the problem. The question is, did the traffic go to Nordstrom? Will likely publish fairly in-line Q4 results, but a stronger performance through February could drive a fiscal year guidance, UBS analyst said in a research note. Floren suggests department stores are still struggling. Quote, we continue to think Nordstrom faces structural challenges which will fuel share loss to off-price retailer brands and Amazon. Views Nordstrom outlook will either deteriorate or improve based on its Q4 results. Wow, thanks. Set to be published on March 5th. Let's see something like this. Nordstrom will likely publish fairly in-line Q4, but a stronger performance could, UBS analyst. Yeah, so I have to assume that UBS has a position in the stock or is building a position in the stock. Because in my eyes, it looks like the company has been struggling. And apparently, again, we're seeing stagnation in revenue potentially moving forward for the next couple of years. So, I don't know. Again, we could look at the several billion the company's bringing in with a market cap of a couple of billion, and we can say, oh, it's undervalued. But again, they're holding several billion in debt, and we could potentially be talking about a dwindling, dying company. Gross profit. What was the last Q4? Gross profit came in $1.5 billion. Operating income's been swinging around. Was several hundred million. Back to 70 million. Yeah, technically going back historically here, the PE could be viewed as a little bit high. Price to sales less than a quarter. Price to cash flow here at 4. Looks like for the most part it was, probably like high 3s, low 4s that would average out to. So that seems in line. Price to book sitting here at about 4.5. Enterprise value, apparently what another company would pay to buy out this stock, roughly double where the stock is currently trading. The return percentages have been increasing for the last couple of quarters. Gross margin back up to 37% as of last quarter. That's the highest it's been going back the last several quarters. Operating margin at about 2.33%. That's been struggling. EBITDA down at 8%. Yeah, not too bad. Net margin sitting at 2%. Inventory turnover took a big drop there quarter over quarter. And we can see, where is Q4? Right here. So this is Q4. And we can see the highest inventory turnover getting to above 4.7. Asset turnover has been decreasing. Yeah, a lot of these debt ratios are kind of near the lowest they've been going back to the last 6-7 quarters. Yeah, honestly, I don't know, because again, it's a rough situation, right? Because we're looking at a lot of these metrics, and I can understand you could definitely make the argument, hey, this stock is undervalued, and we could pop here. Absolutely. The problem is we just don't know. Because again, Nordstrom, I feel like, is kind of going, they're slowly losing their popularity, I feel like, right? So if they're slowly losing their popularity, even if they do beat today and the stock sees, let's just say, a 10% pop and it goes from 20 back up to 22, that'd be great. But chances are, in my opinion, the longer term outlook, it's probably going to slowly give those gains back and go back down to where it was here in the 20s and sub 20s. Because I have a feeling that analysts they're seeing that, yeah, this could be a great quarter, fourth quarter, holiday sales numbers. The other companies have been doing well, so we think Nordstrom will do well. I can completely understand that, 100%. But again, if we quote unquote know, and we're seeing forecasted moving forward that the business isn't really going to grow and we're just going to kind of stay at this level, then we can potentially make the assumption now that moving forward, Q1, Q2 of 24, chances are the company will show struggles again, right? EPS will drop, revenue may miss, and the stock may start to drop down and tank again. So, seems like a difficult one to call, but estimates 436, they post 449 Q4. Estimates go down 434, they post 432. Estimates now back up to 438. $0.88 a share expecting, and then to pull back to 10. Still have not recovered from 17, 18, 19 levels. And again, that was before hyperinflation. So they were charging technically less per item on more traffic, technically, in my opinion. That's how I'm looking at it, to make that money. Yeah, I have to go JWN puts. I really do, in my opinion. In my opinion, I think it's a put play. I really don't think it's a call play. And again, I mean, they could surprise. I understand holiday season. You could see the pop, boom, up to 22 plus, and it could break down out of this like long-term consolidating channel. And I'm sure a lot of people may be pulling for it as well because the stock has been getting beaten up. But in my opinion, I actually think either that EPS number is too high and they miss on the profitability side, or even, again, the revenue, sometimes Q4 beats, sometimes Q4 misses, but overall it looks like the business still hasn't fully recovered from not only pandemic, but even where they were back in 2017, 18, 19, due to the influx of buying coming into the e-commerce segment, right? We all know this. So I think, in my opinion, I think the numbers do come in light, or even if they beat, I think they may issue weak guidance moving forward, and I actually think the stock takes a hit here. I'm my price target personally looking for about 17.5 on a potential miss here on Nordstrom JWN. Recently it's been doing well, of course, since November, but again, everything has been raging, and that's what I mean. We took a stock that fell off a cliff and was in a consolidated zone here, down here at 13.5, 14, and we just ran it up to almost 22. Right? Meanwhile, we know it's inconsistent, and we know it's a company that's struggling to maintain its relevance, if you will. Looks like the MACD actually was just about to cross there to the downside. So this is why, again, we could have a big rejection and a big reversal, and boom, we could drop back to sub 20 here at 19. And again, even potentially back here to the 17s. We were looking at 17.5 on the weekly. Now here on the daily, we can see the 200-day moving average is 1730. And that's also the last time the stock gapped up in almost the first half of December. So in my opinion, I think that's what's going to happen. I think JWN puts potentially back to that 17 in change level. Oh, what else do we have? What else do we have? We have Box, which honestly I don't really know much about. Okay, stock's been bouncing around. Slight miss last quarter. Main line, little beat, beat, slight miss. Okay, so this company seems to be maintaining itself. IT company here, Box, 389 billion market cap. PE is pretty high in my opinion, 142. Earning 20 cents a share. Looking at the EPS side, 2-cent miss last quarter, beating 3 of the last 4 quarters, though. Estimates again of 38 cents coming in. Q4, last Q4, they posted 37 on 34. But if times are rough and they just missed last quarter, we do potentially, in my eyes, have a higher probability to miss on the EPS side of this quarter. Revenue, about 250, 256. 251, 261, 261. Revenue estimates, 263. Okay, now we're taking that next leg higher, but yeah, over the longer term, the stock looks to be growing very nicely. 600 million, 700 million, 770 million, 870 million, 990 million. So we are growing very, very nicely, roughly, it looks like about 80 to 100 million a year, year over year, with the net margin climbing as well. You can see, and this was after lockdowns. Net margin goes from minus 20+% up to single digits here as of last year, 2020. We can see that the company actually went net margin positive there for the year, 2.7%. Q3, the net margin we can see drops down 3. They're kind of trying to keep the profitability up a little bit more. 260s, but now we're positive. That's about $1 billion for the year, so we're trading less than 4 times annual revenue. Let's check the forecast very quick. We're all over the place. 10, 12 analysts. 7 strong buy, 1 buy, 3 hold, 1 giving it a strong sell. Moving forward, we're looking to maintain this 38 a share and go up into the 40s. 6 beats of the last 8 quarters on the EPS side, beating every year on the EPS side. Very impressive. Over here, we can see once we jumped up into the 260 range, all of a sudden we're slightly missing. But again, slight misses aren't necessarily a bad thing. Now we're looking to break to 263, back to 261, up to 270. 5 beats in the last 8 quarters on the revenue side. 6 beats of the last 8 years on the annual revenue side. But they're looking to maintain. In my opinion, I would potentially actually say that this stock is fair valued right here, in my opinion, at about 27, which is why you can see, yeah, look at that. Even going all the way back for the most part here since 21, you can see it's just been bouncing up and down inside of this tight little range. Well, not really a tight range. We broke up to 35 here from 25, but you understand what I'm saying. We kind of just been up and down, bouncing in this range, but we have technically been making lower highs and lower lows, which is why I think we potentially pull back here to about 23. But for the long term, I think I do like this company because, again, we're seeing the profitability growth and we're seeing the steady revenue growth there for the cloud company. So, overall, I'm not necessarily bashing Box. I just think that they may potentially miss earnings and might take a hit here. Debt has been decreasing, 520, 513 cash. Cash has been bouncing around. Free cash flow got up to 120, down to about half that. Assets slightly outweighing liabilities there in the short term. Gross profit now been holding that 190 plus mark now for the last 4 quarters in a row. Very nice. Operating expenses seem to be in line. Operating income bouncing around, getting back to that 8-figure mark, tens of millions. Assets now down to the low 1 billion mark. Liabilities slowly ticking down as well. Liabilities outweighing assets. Assets minus liabilities yields equity. And we can see the equity was positive, got to minus 90 million, stepped all the way to minus 21 million, and now more than doubled back down. We're at almost minus 50 million. With the company holding a couple of $100 million in debt, we can see that the book value per share got up to, well, it was minus 334, and now it's down a little over 10% to minus 375, meaning if this company went out of business right now, technically had to pay its shareholders, you really wouldn't get anything. The PE, again, could be viewed as a little high, 4 times sales, sub 13 times cash flow. That's almost the lowest it's been. Prior to that, it was higher, but enterprise value has been slowly stepping down, even though that's really not something we have to look at. Return percentages seem to be slowly climbing. Gross margin This is actually the lowest it's been going back the last several quarters. This is why I understand if the stock isn't moving, even if we could make the argument, oh, well, they make $1 billion a year. They're only worth $4 billion. I understand. But again, it's the perfect storm of all of these fundamentals and technicals as well. That's what I always say. Operating margin was up to almost 7.7%. Now we're at 4.3%. EBITDA almost double digits again. Not the highest it's been, but on average higher than it was. Net margin we see climbing back up slowly. The asset turnover growth is really nice here. You can see going back about 7 quarters ago, 0.73. Now we're up to 0.99. Yep, debt to assets slowly starting to rise again, though. Long-term debt to total assets kind of back in line to where it was after dropping down. We don't pay a dividend, of course. And yeah, earnings, for the most part, are more positive than negative, especially on the longer-term side. Again, here in the last couple of quarters, we are seeing some slight misses. Yeah, I don't know. Based on some inconsistencies, even though, again, they do beat more times than not, and again, some of these technicals showing me lower highs but lower lows, negative book value, I'm not necessarily bashing the company, and a couple of years from now, they can continue to grow, in my opinion, and get, go from 27 up to 37, and it could be a great longer-term hold, and it looks like the company is growing nicely. If you're asking me immediately in this moment how I personally feel about it, in my opinion, I would go box puts more than likely. Box puts going into these earnings. Again, this is just my opinion. Stock pulling back 2 1/3, bouncing off of this 200-day moving average of 26.99. In my opinion, I think, again, it might not be a big drop, but in my opinion, I just think it drops. I think we break, potentially fill that gap right there from that candle up the other day. But I actually think we retest this 50-day moving average, 25.98. That would be about 1 1/4 point drop. So that's what I mean. It's not going to be crazy. I don't know necessarily if this would be like the highest, the most volatile stock to move after hours. That's not what I'm saying. But overall, looking at the situation, I actually think it goes down before it goes up. However, we could potentially come back to box in the future because I do personally see some growth there, and it could work out well. There was one other tiny company, Presto Automation. There's a company very similar to SoundHound, Voice AI. Why are we all messed up here? So Voice AI, and as we see, we have estimates 4.862 million, expected to lose about 21 cents a share. And you can see the company kind of holding about that 4.8 million mark, slightly missing that 5 million mark last quarter, but coming in EPS positive above those estimates. And before that, again, you can see 4.8 million on 6 million with a big loss. So the problem is this company, a little inconsistent. We had big volume coming in. Supposedly they announced, I think they won some sort of lawsuit. I don't remember exactly where it was. Of course, as I bring up the company, did a direct offering 5 days ago, right? So they got that good news, popped the stock up. Stock was down here at 15 cents, popped all the way up to about 75 and then pulled back. When I first looked at this company, I think it was well over $1. And I said probably at that sub-dollar mark, I may, in my opinion, would have started to accumulate and step in. I think I said a market cap maybe around 50, 60 million. So as you see, even if I did have the cash on hand and I took a position in Presto when I said, obviously, I would still be down significantly on PRST. However, they did sign some good clientele. It seemed like the company was growing. And again, I know they had the litigation issues overseas, and now supposedly that whole situation got rectified. I think they got like 11 million or something. Raises 6 million and wins final appeal case. Do we have the numbers here? I know it wasn't a huge, here we go, the award of 11.1 million. But that is a good sign, though, of course. If another company overseas was supposedly stealing their technology, passing it off of their own, or profiting off of what they brought to the table, infringed on the patents, whatever the situation is. Honestly, I'm not going to go through this whole situation now. You guys can update in the comments section. But based on the rate at which the company was signing clients, and again, I know the revenue isn't really here, 4.8 million. We're talking like 15 million, 20 million for the year with a market cap of 24 million. They have been maintaining that 4.8 million, even though it's technically been stepping down, 4.862. It's going to be hard to call, and again, this one is going to be a difficult situation because it swings so much. It's now sub $1. They recently did a new offering, right? NASDAQ compliance. They've been sub $1 for months now, basically since November. So in my eyes, a potential reverse stock split could be incoming. That, in my eyes, is really the only big red flag with Presto. Because again, getting the ruling there and some awards for the litigation process, and again, slowly signing clients. I don't remember exactly who they signed because it's able to operate through end of months. Looks to raise capital Feb 2nd. Said it likes the capital to operate after January. That's what I mean. So they have to do the offering to raise more cash, and then they have to stay compliant with NASDAQ, right? So they're gonna probably have to do a reverse stock split to get back to above $1. Because again, this legal news is good news, but I just think it might not be enough to really get them up above that $1+ level. But I mean, I don't know. And, in my opinion, it would have to be an excuse me, it would have to be an extra cash play because the company has not proven itself in my eyes on the revenue side. So yeah, it could go from 30 up to 50, and you can see a phenomenal 60-70% return almost instantaneously. The problem is it's not quote unquote really guaranteed or set in stone. Anything can happen, and the stock, of course, could miss and drop down back to 15 cents. So only time will tell. But in my opinion, if you did have excess capital and you feel like you missed out on something like a SoundHound, but you wanted a similar company who's trying to sign new clients and expand in the space, Presto Automation, PRST, may be right for you. But again, very, very cheap down here at 30 cents. Could reverse stock split. Could pop, could drop, but the moves are going to be big. It's going to be very volatile here in the shorter term, in my opinion. So again, in my eyes, if it's money that you quote unquote cannot afford to lose, you probably shouldn't play PRST, in my opinion. MACD potentially crossing to the downside, but let's see how that revenue number comes in. Let's see if they can break above that $5 million revenue mark, and then they might gain some momentum, get back up to that 45-cent top Bollinger Band. RSI sitting slightly below 50, not really a good indicator, and the weekly RSI down here at 33 in my eyes, not really a good indicator. But again, we'll see if they can beat the top Bollinger Band. On the daily was 45. Here we have the mid Bollinger Band on the weekly, 55. So we could potentially have some life here, but unfortunately it's out of our control, and now the company has to do what the company has to do, which is, of course, consistently keep increasing their footprint, increasing their business, and generate more revenue and beat these estimates. And they have to start doing so consistently. They have to show Wall Street, in my opinion, there is value here in this company. You should be buying this dip, buying us sub $1, because eventually, soon enough, we will be back above $1, no problem, on our own. Right? But the problem is, if they can't afford to keep their doors open, have to keep doing new stock offerings, diluting shares, bringing down share price, and then they're going to have to potentially reverse stock split to get back above $1. In my opinion, this could potentially be a recipe for disaster. Not necessarily counting them out as a potential buyout target down the road for their technology and the clientele that they signed up, but in my opinion, the company has to show us value. Otherwise, Wall Street will more than likely keep them down here. And like I said, you're going to have to do more offerings and a reverse stock split. But I'm going to end it there because I talked way too much. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, what is this? What is this? It's canceling its earnings call previously scheduled for 5 p.m. today. The company's Form 10-Q was filed, and the company will communicate business updates and develop to the market when appropriate. Okay. Bad news bears right there, potentially. Cancels their earnings call. All right, so we might get a little bit of a clearer picture after hours, but yeah, in my opinion, when I first look at Presto, I had a feeling it would go down before it goes up. I didn't really expect it to go that low, to be honest, 15 cents. And unfortunately, this one just seems like a crapshoot, in my opinion. And again, it's really up to the company. They have to start beating these estimates and showing some growth again. But yeah, thumbs up algorithm and subscribe to the channel, please, if you have not. Again, that's how you help me help you. But moving forward, more importantly, like I always say, I understand that markets are rocky and volatile and very uncertain. I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Best of luck to you.